Welcome back to another explainer. When most people hear the phrase national income accounting, I bet they immediately picture endless, mind-numbing spreadsheets. But what if I told you it's actually more like a living, breathing circulatory system, one that literally dictates the health of your own wallet? Today, we're going to explore exactly how the wealth of a whole nation is actually measured. Okay, let's dive right into this. We're going to cover the economy's circulatory system, how we model the circular flow, leakages, and injections, and then three big calculations: the value added, income, and expenditure methods. Section 1. The economy's circulatory system, the anatomy of wealth. So before we start crunching numbers, we really need to understand the basic anatomy of the economy. The circular flow of income is basically an economic model. It reflects how money, goods, and services flow through different sectors of the economy in totally opposite directions. This continuous flow, it's the beating heart of macroeconomics. Think about it. The economic wealth of nations is created entirely by keeping up this constant movement. Goods and services flow one way, and the money pays for them, flowing right back the other way. Mapping this whole flow definitely wasn't an overnight achievement. We actually start way back in 1730 with Richard Cantillon, who first tried to model the distribution of farm production. Then around 1758, François Cuisnet created what he called the tableau économique to track agricultural surpluses. Fast forward to the mid-1800s, and Karl Marx built on this with his economic reproduction schemes. Finally, in the 1930s and beyond, folks like John Maynard Keynes and Richard Stone developed the modern, super complex systems we use today, the exact ones the UN and OECD rely on. It's kind of crazy, right? Evolving from tracking 18th century French farmers to setting these massive global economic standards. Now, to actually make this flow happen, we need a few foundational components. We call these the factors of production. First up is land, which is basically all your natural resources. Then we have labor, meaning the physical or mental human work done specifically for a paycheck. Next is capital. And actually, scratch that. It's not just money sitting in a bank. In economics, capital means man-made goods used to generate more wealth. Think machines, tools, factories. And finally, enterprise. That's the entrepreneurship that glues it all together, like the person who decides to take that land, labor, and capital and build a local coffee shop. It's human effort plus man-made tools creating the commodities that keep our whole economies circulating. Section 2. Modeling the circular flow, zooming out. Okay, now that we have our components lined up, let's build our economic engine. We're going to start super small and just incrementally layer on the complexities so we don't get overwhelmed. We start simple with a two-sector model, just households and firms. Then we layer in the government for a three-sector model. Next, we open up our borders with foreign trade to get four sectors. And finally, we add the financial sector. And boom, that gives us the fully complex, modern five-sector open economy. Let's look a little closer at that pure two-sector model for a second. The simple, closed economy. In this scenario, households supply all the factors of production and spend literally every penny of their income. Firms produce the goods and pay out all that income to the households. We're completely assuming there are zero savings and zero government interference here. So in this perfectly sealed loop, aggregate consumption by consumers, meaning the total amount spent, is exactly equal to aggregate expenditure by the firms. It is perfectly balanced. Section 3. Leakages and injections. The engine's pulse. But, as I'm sure you guessed, real economies are not perfectly sealed loops at all. Let's pivot to the mechanisms that actually dictate whether our economic engine is expanding, shrinking, or just chilling in perfect equilibrium. Imagine our economy is like a massive plumbing system. We've got leakages, which are withdrawals that actively reduce the flow of money. And on the flip side, we have injections. These are introductions of income that increase the flow. Just like water leaving or entering our pipes, these forces are constantly pushing and pulling at the total volume of our economic activity. So, where exactly are these valves located in our five-sector model? Well, in the financial sector, the main leakage is saving. Money you stash away and don't spend, while the big injection is investment. Over in the government sector, taxes leak right out of the current income stream, while government spending injects cash back in. And finally, in the overseas sector, imports act as a leakage because our money goes abroad to pay for them, while exports are an injection since foreign money is coming straight into our economy. And this brilliantly illustrates the absolute magic of macroeconomics. When all these complex, constantly moving parts somehow perfectly balance out, we hit the stable equilibrium state. Let's just say that magic state sits at exactly $300. How on earth do we get there? Let's look at the math for our totally fictitious economy. Say our total leakages, so that's savings of $100, taxes of $150, and imports of $50, all equal $300. And then our total injections, investments of $50, government spending of $100, and exports of $150 also add up to exactly $300. Since they match, the circular flow continues indefinitely in a totally stable state. Leakages equal injections. Boom! Equilibrium is achieved.
Section 4. The Value-Added Method. Reading the dials. This is Method 1.
All right, now we enter our final act. How do economists actually read the dials of this giant engine to calculate national income? Well, they use 3 very specific calculation methods, and we're starting with the value-added method. You might also hear it called the product or net output method. This calculates national income by literally summing up the value contributed by every individual firm to the final product across all the different phases of production. It tracks the gross value added across the primary, secondary, and tertiary sectors. So we're talking about everything from farming right down to manufacturing to customer service.
So, the really crucial point here is how the math shakes out. First, we find the gross domestic product at market price. We do this by summing the gross value added of all those sectors. Now, to get to the true national income, which mathematically is known as the net national product at factor cost, we take that GDP, we subtract depreciation, which is just the regular wear and tear on our machines, we subtract net indirect taxes, and then we add in net factor income from abroad. That last one is just money our residents made overseas. It is a very precise, step-by-step algebraic path from what firms produce directly to the nation's true wealth. Section 5. The Income Method. Reading the dials. Method number 2. But what if we looked at the whole economy from a totally different angle? Let's shift our perspective away from what is being produced to what is actually being earned by the residents. This brings us to the income method. This one calculates national income based on total factor payments. Basically, it looks at the paychecks and profits received by residents for productive services they provided during a given year. Remember those factors of production we talked about earlier? Whatever a firm earns in exchange for its goods and services is ultimately used to make these exact factor payments right back to the households.
Here are the specific components that make up this domestic income. You've got compensation of employees, rent and royalty, interest, profit, and finally, mixed income, which is basically just the income of self-employed people. If you sum all of these up together, you get the domestic income. Then, simply add that net factor income from abroad to your sum, and there you have it. You've arrived at the final national income using our second method. Pretty neat, right?
Section 6. The Expenditure Method. Reading the dials. And this is our third and final method.
So we've looked at production and we've looked at income. Now let's look at the final method, which views the economy purely through the lens of who is actually spending the money on final goods. The expenditure method stands on 4 main pillars of final expenditure. First, we have private final consumption expenditure. That is literally just you and me out buying groceries. Then, government final consumption expenditure, which covers spending on public things like roads. Next is gross domestic capital formation, representing business investments. And finally, net exports, which is just exports minus imports, representing foreign spending. Now, what's really fascinating about this is that despite taking a completely different mathematical path by adding up final expenditures, we arrive at the exact same final formula. First, we sum those 4 pillars to get gross domestic product at market price. Then, exactly like the value-added method, we subtract depreciation, we subtract net indirect taxes, and we add net factor income from abroad. And that deduces the final national income. 3 totally unique dials, all measuring the exact same powerful engine.
But let's end this explainer by zooming out just a little bit. You see, these dials absolutely tell us our nominal GDP, but they don't necessarily account for changing goods and prices, or inflation, meaning real GDP often paints a very, very different picture than nominal GDP. Nor do these dials measure true human welfare, happiness, or any of the hidden costs of growth. Furthermore, if the circular flow operates like a perpetual motion machine, constantly converting resources into wealth, how long can it actually continue before it exhausts the finite, low-entropy natural resources of our larger ecosystem? The laws of thermodynamics clearly tell us that no system can recycle waste infinitely without some kind of new energy. Our economy is, at the end of the day, a subsystem of our environment. So what happens when this incredible engine of infinite economic growth hits the very real, finite limits of our planet? I'll leave you to think about that one. Thanks so much for joining me to understand the true pulse of our economy.